What we're going to be looking at here is debt restructuring by the modification of terms of a loan. And for example, we're going to be looking at where we have a gain to the debtor here and a loss to the creditor on this loan. And we're going to be calculating and recording these gains and losses here by the debtor and by the creditor here. So for example, here on 12/31/20X1, Bank B enters into a debt restructuring agreement here with Corporation A. Now, Corporation A is experiencing financial difficulties here, and they're not going to be able to pay Bank B here on a note that's payable to Bank B here. So what Bank B is going to do is they're going to restructure a $1 million loan receivable here from Corporation A here, and it was issued at par and the interest is paid up to date, so we're not going to have to worry about the interest in this example. And the note is restructured by, and these are the 4 points that for the restructuring of this note or this loan, and these would be the typical items that you have to look at when restructuring a loan here. Number one, you're going to be reducing the principal obligation here from $1 million to $700,000. So Corporation A originally had to pay the $1 million here on this loan, but now they're only going to have to pay $700,000 of it. So number two, we're going to be extending the maturity date here from 12/31/20X1 here out 4 years here to 12/31/20X5 here. So originally this loan was due here at the end of the year here at 20X1, but now it's going to be extended and it's going to be due here at the end of year 20X5. Extended 4 years here. And the other thing we're going to do is we're going to be reducing the interest rate here from 12% to 8%. Now the 12% would be called its historical rate here, or the original rate on this loan here, but now it's going to be reduced here to 8%. And then we would have a reduction or a deferral of accrued interest. But in this example, like we said, it was paid up, so we don't have to deal with that, so it's not required in this example. All right. So let's go over here and let's first look at it from Bank B, the creditor's perspective here. And they're going to have a loss here on this restructuring of the debt here. And it's going to be, from Bank B, it's a note receivable. And for Corporation A, it'd be a note payable here. But again, the principal is being reduced from $1 million down to $700,000 on this note here. And the interest rate is being changed or reduced from 12% here, the historical rate, or the original rate here, down to 8%. So what we have to do here from Bank B, the creditor's perspective, we have to determine, in this case we're going to have a loss here on restructuring. And that's really the difference between the present value of these restructured cash flows that we'll calculate here and the difference and the pre-structured, or the before we restructured this loan here, the carrying value of this loan here, this notes receivable. So our pre-structured carrying amount, we'll just point out here, is $1 million. But now for our present value of these restructured cash flows. So we're going to have the present value of that principal amount that's due here, that $700,000 that's due here in 4 years here. And in this case, when we're working with determining our present value here, we have to work with the historical rate here, the original rate, the 12%. We don't use the 8% or the restructured rate or the reduced rate here, but of 8%. We use the 12% here for both present value of our payments and the present value of our principal. So just looking at it in terms here, I'm using the Excel function. For our principal amount, that was $700,000 here for 4 years at 12%. Its present value is $444,863. Use Excel or your financial calculator. Now for the present value of those interest payments. So the interest payments are going to be $56,000 per year. It's going to be the 8% reduced interest rate times the $700,000 principal amount. So that's interest payments they're going to be paid or received on this loan here are $56,000. Again, at the 12% historical rate. Sticking that into your function here, your calculator, the present value of those interest payments is $170,092. So the present value of the principal plus the interest payments would be $614,950. So that's the present value of our restructured cash flow. Now, comparing that to the pre-structured carrying amount here of $1 million, the difference here gives us Bank B is a loss here on restructuring of $385,045. So they're only going to be getting, on the present values terms here, they're only going to be getting $614,955 based on the pre-structured, or the amount that was originally due here of $1 million. So there's our loss here on restructuring, $385,045, and that's going to go against the bad debt expense here for Bank B. The other thing that Bank B has to do is they have to come up with a new effective or amortization schedule on this loan here, on this note here, based on the reduced debt. But before we get into that, let's go down and look at Corporation A here, the debtor, where they're going to have a gain here. All right, so what Corporation A has to do here is they have to determine the total future cash flows after restructuring. So let's go back to our amortization schedule here. So maybe we should go through that here for Corporation A and Bank B. So what Corporation or Bank B was going to get here at maturity is $700,000. Now, that's what Corporation A is going to pay here, and Bank B is going to get the $700,000. That's the principal amount. And the other thing that's going to be paid here by Corporation A and received by the Bank B here are those 4 interest payments here of $56,000 each for $224,000. Okay, so for Corporation A, the debtor, you can figure there's this gain in this fashion here. So you took the total future cash flows after restructuring. That is the $700,000 principal amount plus the $224,000 interest amount that we have up here. That total amount here is equal to $924,000. Okay, so that's what their cash flow is going to be and what they have to pay out here, Corporation A. Now, what we have to do is we have to compare that to our pre-structured carrying value here. So it's the $924,000 here is less than the total pre-structured carrying value here of $1 million. So all they're going to have to pay here is this cash flow is $924,000 here, and they would have had to pay $1 million here based on the pre-structured carrying value here. So the debtor records a gain here, and it reduces the carrying amount here of the payable, the difference here between the $1 million original amount here and the $924,000 here pre-structured amount gives us a reduction in the payable here of $76,000, and that is the gain that they're going to have here, $76,000. Now let's go back to our amortization schedule here, and this is what Bank B has to deal with. So again, we had this, we know what our payment amount here is. That's that $56,000 interest payment they're going to be receiving here from Corporation A. The 8% here times the $700,000 maturity value here on this note. All right, so we got those here. 4 payments here at $56,000 per year, so the total payment amount they're going to be receiving here is $224,000. Now for our amortization here. Again, our interest expense, or the effective interest expense here, is going to be based on that 12% historical interest rate. It's been reduced to 8%, but we have to use the 12% here. And what we would do here for just our amortization, so we take our beginning reduced debt here, the beginning carrying value here is $614,955. Just so you know where that come from, we can go back up here. That was the present value here of the principal amount plus those payments. So that becomes our beginning carrying value here of $614,950, and we have to amortize it up here to $700,000 over the 4-year period here. So for our amortization, we just take the beginning balance here, $614,955 times the historical interest rate of 12%, and we're going to get an effective interest for the year here of $73,795. So we would be subtracting that here from the payment amount of $56,000, and that's going to equal the increase in the carrying value. The difference between effective rate here and the actual cash payment is $17,795. So that is what we'd be adding to our beginning balance here to come up with our new balance, and then we'd just be amortizing that in the same old fashion. New balance times the effective interest rate here, compare that to the cash payment, and that would be your amortized or increase in your carrying value, amortized amount here, and then you just add that to the beginning balance, and then you just move on down here and amortize it over these 4-year periods. So here we sit at maturity value here of $700,000. That is what Bank B would be getting on this loan here, or from Corporation A. Corporation A is going to pay this. Bank B is going to get this principal amount here of $700,000. And just to looking at our historical or effective interest rate here, total amount would be, the effective rate is $309,047. Compare that to the payment amount here of $224,000, and you're going to get your amortized amount here of $85,047. So what we've done here is we've just amortized this principal amount here up from $614,955 up to $700,000. So this is our amortization schedule. Now we can move on and look at how we'd record this here. The loss by Bank B here, and a gain by Corporation A as a debtor here. All right, so we'll move on to that. Now let's look at how to record this here, and we'll start with Corporation A, the debtor, and we'll look at the gain here after restructuring this loan or this notes payable. So starting out with our gain here on our income statement. At the restructuring date here, 12/31/X1, they would have credited that here for $76,000, and that's based on the fact that they had a note payable of $1 million here, but they're only going to have to pay the principal amount back here of $700,000 plus those interest payments of 4 years at $56,000 each per year. For $224,000. So what they're paying back here is $76,000 here less than the original amount that was owed here, $1 million. So that's the gain here that they would credit on their income statement here to the gain here on this debt restructuring. Then the debit amount here would have to go to the notes payable being restructured here on the balance sheet. They would have had to reduce their notes payable by $76,000. So you have debit here and notes payable of $76,000, balances with the credit here, gain on the income statement of $76,000. And then the only other thing to deal with are those interest payments. That revised interest rate of 8% times the $700,000 revised payable here on that note for $56,000 per year here for the next 4 years. Okay, so we credit, reduce our cash by those interest payments for $56,000, and then we debit or reduce our notes payable by $56,000. Okay, and then the only other thing they have to deal with here is at the end, we've got a notes payable here after reducing our notes payable by the principal amount plus those interest payments. We're going to come up with $700,000 here in notes payable. So to remove it off the balance sheet here, we'd have to pay it. So we debit our notes payable by $700,000 off. It removes off the balance sheet, and then the credit here would go to cash, where they'd have to pay out the $700,000. Again, here at the maturity date, 12/31/X5. Okay, so that takes care of our Corporation A, the debtor here. So let's move over here to Bank B, the creditor here. We're going to have a loss here after restructuring, and we're also going to have this interest revenue. So again, let's start with our bad debt expense here on the restructure to this notes receivable. That's going to be our loss here. So what we would have done here, we would have debited or increased our bad debt expense by the amount of that loss here based on that present value calculation that we made here of $385,045. Okay, so that is again at the restructuring date here, 12/31/X1, bad debt expense on our income statement. Now, the balancing amount would go to the allowance for our doubtful accounts here. It's a contra receivable. This reduces the notes receivable, a contra account here. So we'd have credited our allowance account here for $385,045. And that was our bad debt expense. Debit that on a bad debt expense here, credit our allowance account here on our balance sheet here. By that amount here, and that reduces our notes receivable here. And then as time passes here, we'll just look at it, and we can go down here and look at our amortization schedule. So for our allowance for doubtful accounts here, this contra receivable, we would debit that or reduce it here by, and let's just go down by the principal here, principal amount here of it's showing here, $17,795 for the first year, up to $25,000 here for the fourth year here, where we're increasing our principal amount. So that would be our debit or a reduction here in allowance account. So at the end, we're going to come up with a balance amount here of $300,000 that's going to be our allowance for doubtful accounts here at the end of the fourth year. Okay, and then before we do that here, before we close these accounts out here, let's look at this cash account here, and the restructured notes receivable. This is the cash amount that we're going to receive, those interest payments here, the 8% times the $700,000 principal amount, $56,000 for each of the next 4 years. So we debit or increase our cash account for that amount. Okay. Oh, one other thing, and okay, we've got our debits here to our cash account for $56,000 here, and we also got our debits or reduction on our allowance account here by those amounts here coming off that table here, our table here. Our cash account came off the payment amount here in the table, and then the reduction here of our principal, or our increase actually in our principal, came off the table here. So that's showing up here. Then the other thing we have to deal with is this interest revenue on our income statement, and that's at the historical rate here of 12%. Again, that's going to come off our amortization schedule here, the interest that we calculated here. This was the effective interest that we're receiving here. So those amounts here, $73,795 here for the first year. That would be what we'd credit or increase our interest revenue here on our income statement, and by that amount here, from $73,795 up to $81,000 here in the fourth year. So credit or increase our interest revenue here, and then remember this, we had our bad debt expense here of $385,000. So you can see the interest revenue here is actually reducing this bad debt expense. And again, the interest revenue here, that was you can look down here, our A and C amount. That was our payment amount here of $56,000 each year here, plus the principal amount here that we were amortizing up. Okay, so that takes care of our amortization here off our amortization schedule, except for we have to deal with when this note comes due here. So when it comes due, we would credit or credit out the $1 million maturity original amount here of $1 million, and then the allowance account here, we had a credit balance here of $300,000. That would be closed out here and debited here by $300,000. So we removed our notes receivable off the books here, and then the other thing we would do is we would have received cash or debit or increase our cash here by $700,000. So this is how we've taken that here. So we've taken care of the $300,000 here, our debit amount here, plus our $700,000 debit amount here to the cash on that restructured notes payable, balances with the credit here of our notes receivable of $1 million. Okay, so that takes care of our Bank B here, the creditor. Just remember, you have to put in your bad debt expense here based on discounting that present value of those cash flows here, and then you also have to remember the interest revenue here, and that's at the historical rate here, and that's coming off our amortization schedule. All right, so that takes care of Bank B, the creditor here, and Corporation A, the debtor here on this note that was restructured.